all of them are looking to be more profitable, improve their loss ratios, improve their underwriting, and they are struggling to do that. And the common theme that I notice is they're not leveraging location technologies enough to improve their risk assessment model. Hi, welcome everyone. Welcome to today's episode. In today's episode, we are going to be talking about how location technologies help auto insurance companies become more. I'm Vinod Kumar Poomalai. I'm an expert at applying location technologies to retail, logistics, and the insurance space. I've been in this space for the last 10 years, and I'm going to be drawing from my experience of working with insurance, insurtech, and actuarial companies to tell you the most important use cases that, as an insurer, that you should be looking to implement with location technologies. In my conversations with insurers across the globe, there is a common theme. All of them are looking to be more profitable, improve their loss ratios, improve their underwriting, and they are struggling to do that. And the common theme that I notice is they're not leveraging location technologies enough to improve their risk assessment model. In my experience, there are three major use cases that insurers should look to leverage that are dependent on location technologies. The first one is what I call territory risk assessment. This is about assessing the risk associated with a driver based on where the vehicle is garaged, the demographics, and also incorporating the environmental risk factors that determine how risky that particular driver is. The second use case is related to usage-based insurance. This is a use case that I see picking up more and more traction. This is really about differentiating a good driver from a bad driver based on the individual driving behavior characteristics. And I see location technology is not leveraged enough to be able to do that. The third use case is at the stage of claims validation. It's about detecting more and more fraud to be able to reduce the losses associated. In today's episode, we are going to be looking at all of these three use cases in detail. I leverage a map element to show all of these three use cases more visually. And let's dive right in. Let's talk about the first use case of territory risk assessment. I've seen insurers build territory risk scores at a zip code level or a census boundary level. What this means is if there are two drivers coming from the same zip code and they're of similar demographics, they would most often be treated as very similar risk and their pricing would reflect that. There are two problems with this. Number one is it doesn't differentiate the risk within the zip code level. The risk really varies from road segment to road segment, from a street to street. And number two, these models are very static. It doesn't take into account the dynamic nature of the real world. It doesn't take into account the changes in traffic patterns, the changes in construction patterns in the different zip codes. What this results in is poor underwriting. It most often overcharges a less risky driver and undercharges a high risky driver, resulting in problems with customer retention and loss ratios. How do we solve for this? I'm going to specifically show 4 map and traffic related features or attributes that help territory risk models become more granular and more dynamic. Let's dive into it. I'm going to be talking about 4 different map and traffic data elements which have high correlation with the riskiness of a particular territory. The first one is the number of road segments. The more are the number of road segments in a particular territory, more risky the territory is. This one is obvious because more road segments indicate higher complexity of driving and hence higher riskiness in that particular area. Number 2 is traffic counts or traffic volumes. More traffic volumes that you observe in a road segment seem to be indicative of the collision frequency in that particular road segment. Number 3, speed variability. Speed variability is something that is extracted from the historical traffic patterns in a particular road segment, and what we have seen is higher the variability, higher is the collision frequency in that particular road segment. Number 4, average speeds in a road segment. This one is interesting because this has an element of difference when it comes to speeds, average speeds in the highways versus average speeds in the urban road. What we've seen is higher average speeds in highways indicate low risk, but when it comes to urban roads, higher average speeds indicate higher risk. Let's talk about the second use case of usage-based insurance. This use case is about differentiating a good driver from a bad driver. What I've seen companies do is they make use of data coming from telematics applications and driver mobile applications to be able to extract driver behavior information. It is by extracting driver events such as harsh braking, speeding violations, acceleration events, that you would be able to differentiate a good driver from a bad driver. You would assign different risk scores and you would use that to price them differentiated. The problem here is companies are not using enough map and real-time traffic context to the driver events. For example, a harsh braking event occurring in a parking lot is drastically different from a harsh braking event occurring at a high-speed intersection. Today, companies are not differentiating this. So what this results in is underpricing of bad drivers and overpricing of good drivers, resulting in problems with retention and loss ratios. Let's dive in how companies could resolve this by making use of more contextual information from map data and real-time traffic data. So today, what insurtech companies do when it comes to usage-based insurance use cases, they snap the GPS traces coming from the telematics applications and driver mobile applications onto a good map data, and they try to detect very basic events such as speed violations. So they compare the speeds of the driver versus the allowed speed limits in a particular road segment to detect speed violation information. But that is very basic. You need to go beyond. The GPS traces also have other information. You can use the GPS traces and compare it against the turn restrictions in the map data to know whether a particular turn is an allowed turn or a legal turn, and you could make use of that information in further segmenting the riskiness of a particular driver. You need to go further. You need to assign the context to where and why a particular event occurred. So what it means is a harsh braking event occurring in a parking lot versus a high-speed intersection is drastically different. You would score the riskiness of that event in a different way, and that would impact the riskiness of a driver who is involved in that particular event. The second is you need to understand why a particular event occurred. Right? You need to bring in elements from the real dynamic world, such as real-time traffic information, weather information, to be able to assign context of why a particular event occurred. Did that harsh braking event occur because there was a traffic jam or a traffic accident in front of the driver, or was it because of a weather event before the driver? Right? You need to take that into account so that you are able to assess the riskiness of a driver in a more precise manner, so that you would fairly price different drivers. And that has a direct impact on retaining good drivers and improving loss ratios on bad drivers. Let's talk about the third and last use case of auto insurance fraud detection. Auto insurers have the ability to leverage location technologies to do better claims validation. What it means is to verify the reasoning for the claim as well as the location of the claim. Let's look at a couple of examples on how to do this. The first is verifying the location of the claim. Make sure that you use the GPS traces from the vehicle to see if it matches with the location mentioned in the claim at the time frame of the claim. That's number one. Number two is to verify the reasoning provided in the claim. If the claim says that the event occurred because of a congestion event or a roadwork event, make sure that you leverage the historical traffic information to see if that event was indeed present in that location during that time frame. By incorporating this data and these checks as part of your fraud detection models, you'll be able to improve the loss ratios drastically. So to sum up today's episode, we learned how auto insurance companies can leverage map and traffic data to do better underwriting and be more profitable. We specifically looked at how map and traffic data help them create better territory risk assessment by making them more granular and more dynamic. We also looked at how map and traffic data makes usage-based insurance programs more effective. We looked at how it can make claims validation process more fraud resistant. These are all foundational use cases for auto insurance companies to continue to improve their loss ratios and be more profitable. If you're somebody who's working at one of the insurance or insurtech companies, do reach out to me if you want to discuss about these use cases further. Until I talk to you in the next episode, stay curious.